Welcome back to another episode of Asset Coach and Tax Strategist. And so, our last episode, we talked about taxes, and we did spend a fair amount of time discussing and talking about taxes. And it's more than just a half-hour conversation. I mean, there's so many different ways to go the ins and outs of taxes. And so, what I'd like to do is today we're going to talk about inflation. And the interesting thing about inflation is that it's kind of the silent tax, right? That's what a lot of people talk about. But before we dive into there, let's do a quick synopsis and summary of the last episode, but also let me add some other context to that and talk about that a little bit more. So, really, from the very baseline, again, we need to understand that the tax code is written for business owners. Okay. And the reason when you look at that, you got to look at the government as a business. Now we look at it as a government and that it's not considered like us as a business owner or business owners that we know, but it's a business. Okay. And government has always been a business from when it was the monarchs and a king. They needed taxes to be able to hire people to protect and go pillage and take over other kingdoms or land or whatever the case may be. Today it's a lot different, right? It's a little more we would like to say more sophisticated, right? More complicated. Maybe it's not. Maybe it's still as simple as it's a business and there's a cost to doing business. And so the government has to generate revenue one way. And one way is the traditional way of capitalism, and that is trading time for dollars. Okay. And in order for those time and dollars, that value, I say dollars, but we're really talking about time and value. If we're going to do something, what value is in return? So when the fiat currency first started occurring, it was initially shells. And then it was a barter system, right? It was value and it's exchange of value. But in order to provide that value, there had to be a time that was invested in that. And then as time progressed, we of course became a little more sophisticated and figured out how do we create coins, how do we create paper currency to exchange that value, and then the government backed that up by gold, and then they stopped backing it by gold, and now it's all kind of funny money and by the power and the strength of the United States. So when we look at that as a business, they generate tax revenue. Tax revenue. That's how they're generating their income through tax revenue. Now they've become very good at developing different revenue streams within the tax model, not just from a local government all the way up to the federal government, but they become very sophisticated in understanding the algorithms of where that flow of cash can and where they can get the best return on the value presented. So, in order to get taxpayers, how do you get taxpayers? Well, you could be a government worker, right? Where you're an employee, but that government is paying that worker. Where are the funds going to come from for the government to be able to pay that worker? They have to come from somewhere, right? And so that's where you have the private sector. The private sector is you and I as business owners, the small business owner, to where we end up providing goods and services that value in exchange for a financial return, typically dollars. And then that becomes revenue to us as a business. We have our expenses to run that business, which is where the government partnership comes in and they say, hey, we're not going to tax you at the top line revenue. You can utilize these expenses as cost of doing business to help you grow your business. We're going to allow you to have more cash flow and not tax you on that. And with that extra cash flow, what will eventually happen, because this is our livelihood, is that business is not an easy thing. It's something that you go out and you strive for and you struggle for and you scratch and scrape and you do everything you possibly can. Whether it's something that it was in your heart from a little kid to an adult, it does not matter. It's difficult. Okay. Now, I'm not saying being an employee is not difficult. You have different challenges, different headaches, different issues you have to deal with, but you have less control. And a business owner, you really have less control too, but you have control over your actions. Your key performance indicator really as a business owner should be a key performance action? What actions can I control that I take to help drive those KPIs, these key performance indicators, to grow my revenue? So let's say that less of taxes. So we have the expenses. We're reducing our tax liability because we get to write off the expenses. And let's say I end up having $30,000 more in cash flow. What am I going to do with that? I can put it into marketing. I can take it personally and I can go buy a boat. Well, which I'm not going to go do. I can do what with it? Well, you can probably put it into marketing, or you can hire a salesperson, a 1099 independent contractor salesperson to sell your goods and services or widgets or whatever you're providing. Whatever it is, you're able to utilize that fund to invest back into your business. And with the plan that it'll help you increase your revenue, and then all of a sudden you have to do what? Hire more people. And those people you pay payroll taxes for, Social Security tax, Medicare tax, right? And so do they. Pardon me. And so do they. And that's the revenue that comes to the government. The government uses the tax revenue to help their creditworthiness to be able to sell bonds, debt to other countries, that those countries can feel confident that if I lend money to the United States, they have the financial wherewithal and backing, financial crediting, to pay for that debt back. And then whatever's different, they print money. We can't do that. We can't do that as a taxpayer, as a business owner. Okay. So that's the core understanding of that. Okay. Now, the Federal Reserve has a goal of inflation of 2%. And what that means is that the value, the supply and demand aspect of the economics of, if you have a good, let's say, let's just use sunflower seeds, for example. And you're at a baseball game and you have these sunflower seeds and you share them with other people, and other people are like, oh my goodness, these are the best sunflower seeds ever. And because it's in your local community, all these other people go to the store and they start buying sunflower seeds. And now there's no more sunflower seeds on the shelves. So the demand of sunflower seeds has increased. What's the store going to do? They're going to go buy more sunflower seeds. They're going to provide more supply for that demand. Okay. And then they may realize, hey, I could probably charge 25 cents more for these sunflower seeds because there's such a great demand for these sunflower seeds. And so what do? Instead of it being $2 a bag, it's $2.25. And so you have all these people buying it, and the grocery store makes an extra quarter on each of these bags. Then all of a sudden the supplier realizes, wow, this grocery store is buying a lot of sunflower seeds. Maybe we can increase our profit a little bit. And so they increase their profit by 10%. And so that eats into the grocery store's profit, right? But you as a consumer are still paying $2.25. But then the grocery store says, well, the demand is still high. Maybe I can raise this to another 25 cents to $2.50. So they do that, and the demand is still strong. And then they raise it to $2.75, and then the demand starts to weigh. It becomes too expensive. And that's essentially what happens with inflation. Inflation is the power of supply and demand of you and I and the consumers in the marketplace determining and dictating what the demand and the oversupply of something. Okay. And so inflation, the government's inflationary goal for dollar is 2%. So if you're familiar with, let's go ahead and share my screen here. And so, and if this is the second termite inflation in my book. So if you go in there, and so you can go through and read all that. But if you look at the rule of 72, the rule of 72 is what a lot of financial advisors will use to help give you an idea of how the return on your investment, your money can double, right? So if you're going to earn at 8% on the S&P 500, and you divide that into 72, so you take your calculator and do 72 divided by 8%. Oh, every 9 years at 8%, every 9 years, my money is going to double. So if I invest $100,000 into the S&P 500, as an example, this is not investment advice. This is an example. We put $100,000 in, I'm getting an 8%. In 9 years, my 100,000 should be 200,000. Right. And then in another 9 years, my 200,000 should be 400,000. So 18 years, I should have 400,000. And then another 9 years. So in 20, what is that, 24 years, I should have 27 years, I should have what, 800,000, right? And so that's the ongoing. So the opposite is true of interest. So inflation 2% or credit card debt or whatever will eat away at your wealth as well. So if I take the 72 divided by 2, that means every 36 years, the value of my dollar gets cut in half. Okay. So let's say I'm 20. I enter the workforce. I'm 20 years old, and you add 36 to that. Now I'm 56. So my dollar at 20, now at age 56, is worth half. So what do I have to do to recoup that and recover that, right? And so that's essentially what's happening with inflation from a rule of 72 perspective. So if inflation increases to 4%, well, you divide 4% into 72, and now every 18 years, that dollar becomes worth 50 cents, and then 50 cents to a quarter, right? And so this is why it's called the silent tax, because it forces all of us. So when California says, oh, minimum wage is going to be $20, by the way, minimum wage entry level jobs are not career jobs. Those are supposed to help the young, the newly employed, to learn a work ethic, to go in the workplace, to learn responsibility, earn a little bit of money, to be able to teach them the responsibilities of society, not to raise a family from. When I go buy a burger, my burger is not going there to be able to pay for a family of 5 to live a lifestyle, because that worker is a minimum wage worker. Okay. But when California increases minimum wage to 20%, what does that do? Go back to my sunflower seeds example. It's going to drive the costs up. That's inflation. And you're going to need more money. So now you're going to be disgruntled with your job because now you're not making enough to be able to pay for food on the table and the basics of your life. And so what do you end up doing? You start looking for another job and you go make more money. And when you make more money, what are you doing? Paying more taxes. So I don't think the government is really all that concerned about inflation, because inflation drives the capitalistic economics of supply and demand, and it drives incomes higher, which means it drives tax revenue higher. Okay, that's the basis. That's why they got away from gold. That's why they went to interest rates, so they can control the economics of the flow of cash. Okay, and so you in my book, you can go through and we talk about the rule of 72. You can look at the history of inflation, all this fun stuff. Great information. Okay, what you would need from in let's see here, in 2000 to 2022, if you had $1,000 at the average inflation at the time of writing is 2.49, you'd have to have your $1,000 would have to be worth $761 more. All right, that's a ton. But let's go to a website that I think is a great website. It's usinflationcalculator.com. And I'm going to increase the size of this a little bit. And so what I like about this particular calculator is it has a live calculator in here. So for example, if in 1913 I purchased an item for $1, then in 2024 that same item would cost $31.73 for a cumulative rate of return of 3,073 and half. Okay, so let's say in 2000 I were to purchase a burger for $5 in 2024, now it's worth $9. 24 years later, almost doubled, or an 82% increase from that period, from that $5 to $9. That's pretty spectacular, right? So you can do this for pretty much anything you want to do. So I mean, essentially, well, let's see what if this would calculate 2024, and let's say in 2030 I purchased something for $9.12. They can't predict the future. Why? Because this calculator is based on past data. Okay, so that's interesting. So it doesn't even use the average. It doesn't even use the inflationary goal of the government. Okay, so we can say, hey, 2024 should be that number, and then we should say, okay, if I were to in 20 years, so 2004, what would this look like? Um, wow, let's do that $5 again. Okay, so it'd be $8.32. So if it was $8.32, what would that be? That'd be $13 and wow, that $5 now tripled, right? So you can go through here and you have current US inflation rates, historical data. There's a lot of information here. You can go to food and gas, so food inflation, which is important. Why is this important? Well, because we eat. We need to eat. Right? I mean, at the end of the day, we got to put food on the table. We've got to drink water. We've got to have a roof over our head, right? There's certain basics of things that we need to have. Look at food at home. So that's not bad. It increased by 1.1%, but food away, 4.1%. That's pretty significant. Why? Because all these other costs and the costs of you and I as employees. Okay. What California is doing is that they're really forcing businesses, small businesses, especially these franchises, they're forcing them to be more automated, to run businesses without humans. Okay. And what's going to happen is that demand for the machinery and equipment is going to cost more, but it will last longer. It can do more without having to deal with, you being out sick, you having car trouble, you having kids, you deciding you don't want to work that day and you're working half-ass, or you taking French fries or a burger when you're not supposed to, right? So there's certain things that we as humans are driving our employment opportunities away. And so when the government makes these decisions, they're unemploying you. They're pushing you into a category where, well, minimum wage, you got to increase minimum wage because these people aren't smart enough to work a better job. How about instead of driving minimum wage, well, how about you offer opportunities for these people to improve their education to where they can go earn a higher paying job or get technically more advanced. Now, if people don't want to do that, that's their problem. But when you enable them, okay, and this is all my opinion, like it or leave it. I honestly, I don't care. This is the reality of what we're dealing with, right? In order for me to replace myself of 20 plus years of experience and expertise in my workplace, it would be so, I would have to spend literally 5 years of training, teaching somebody what I've learned in 20 years for them to create an output of what I'm able to do. Then I've just lost 5 years and I've added 5 more years of experience that this individual that I've taught in 5 years doesn't have. So what do I have to do? I have to do what a lot of people do is how do I take what's intellectually in my mind and put it into this is the amazing thing about Henry Ford into his assembly line of what things can I do to where I can have people be able to do and insert people in and out depending on that particular person. How can I automate this? Can I use softwares to use certain parts of it? And what's that look like? And all of this drives inflation. And as inflation forces our goods and services, our value higher, that means you and I have to earn more. That means you and I get taxed more. And who collects those funds? The government does. Okay. And so it's important to understand that aspect of how this works. So hopefully this was helpful. And thanks so much if this information was good, give us a thumbs up. If you have any comments, drop your comments down below. Would love to hear your comments and your opinions. And if you want to hear any other future things or there's any past episodes that you're like, hey, Bob, can you dive more into the weeds on that? Would love to be able to do that. Just add those things in the comments. Feel free to share us. You don't have to keep us a secret. It's not just between you and I. Go ahead and share this information. The more you and I have this information, the more we understand the rules, the more we understand the game, the more we can go out and effectively rising tide rises all boats. We all benefit and from this education and knowledge. So can't just keep breathing in, you have to breathe out. And so the implementation of knowledge is the power, not just the knowledge itself. So thanks so much. God bless you. And this is Bob Wolf. I'm an asset coach and tax strategist.